So much. That was such a nice intro, and I really appreciate you having us. Getting shit done is something that resonates with both me and Scott. So yeah, so here's our presentation. Everybody can see that, okay?
Yep.
Okay,
You
cool.
see just fine. Go for it.
Well, my name is Ryan Gibson, and yeah, I live in Seattle, Washington, and co-founded Spartan Investment Group with Scott Lewis. And a little bit about, I'll kind of dive a little bit into our background, but tonight I was going to talk about the asset class, and you're probably thinking, what does self-storage have to do with Burger King, McDonald's, and Starbucks? And what's interesting is that if you took all of these store locations combined, so all the Starbucks in the United States, all the McDonald's in the United States, and all the Burger Kings, and you combine them all together, you still wouldn't have as many self-storage facilities that exist in the United States. So there's about 60,000 or so self-storage facilities. And if you combine all the fast food chains together, there's still more storage. So America loves storage. So we'll talk about this, a little bit more tonight, but just a little bit more about Spartan. We made the Inc. 500 last year, which was a big deal for us. We're confident we're going to make it this year, and might be a little bit higher up the rating. We're very fast growing company. We run a brand called Free Up Storage, which is our national brand that we launched late in Q4 last year. We're rebranding all of our properties into the Free Up Storage brand. That's our team down there on the bottom left, or portion of our team that's in our office. We're in Golden, Colorado. That was taken a little while back. We also have a Seattle office, primarily capital markets and investor relations is in Seattle. We're based down in Westlake, right by Kenmore Air, if you're familiar with Seattle. And in Golden, we're pretty much right down the street from Coors. Just a little bit about us, about 7,000 units under management, ownership, about 43 full-time employees. We have about $150 million portfolio, 200 plus active investors. That private equity raise has jumped a bit since I got to update my profile.
Yes, you should.
And we've got about 9 projects that have gone full cycle and about 17 or so active projects today. But just a little bit about me and Scott and how we met. This is a really cool story. So if you see the house in the middle there, that was Spartan's first flip. So we actually bought that house. It's in our nation's capital. And the house on the left, the White House, that was my house. And then the house that's green that matches Scott's uniform there was Scott's house. And so I moved into this neighborhood. It was a changing neighborhood, and a lot of houses were being flipped and redeveloped. It was in 2009. I bought my house. I gutted it down to the studs. It was my first kind of hands-on real estate experience. And I was very desperate for the houses to sell in the neighborhood because a lot of them were boarded up. And Scott and his wife were walking down the street one day, and a little sales technique. I would go out and pretend to check my mail every time somebody would walk by his house that was for sale at the time, and pretend to strike up a conversation. So my wife was kind of laughing because it was like my 11th time checking the mail that day. And Scott was a very outgoing guy. I'm a very outgoing guy. And we struck up a conversation. And so we became neighbors, eventually friends. And then we had backyard barbecues and we're hanging out, and there's this abandoned house in between us. And we're like, let's figure out how to take down that house and flip it. We're both very entrepreneurial. And so you'll appreciate this, Kirk. It went to tax foreclosure. The owner died, his son died, a brother died. Nobody had the rights to the title. It went to tax foreclosure, but then the taxes were paid off, but it wasn't recorded correctly, and the tax lien was held by an LLC that had dissolved in the 90s, and they had moved off and disbanded into New York City. So we had to track down those guys and get quiet title and a quick claim deed, and thank God they agreed to it. And then we set up probate for the seller, who was a nephew who didn't even, or a niece who didn't even know what to do. She had high medical bills coming due. She had a family emergency, and she had no idea how to unscrew the title, basically. And we took her every step of the way. We paid all of her legal bills, got the property freed up, and then took ownership and flipped it. And that was our first company project. And Scott and I learned something along the way, and it was, well, we know what the company's mission statement is, and that's to improve lives through real estate. And it was really cool because we really helped her out. We made a tremendous profit for the project, and we didn't do it correctly in the way syndications go, but we were able to raise capital with friends and family and take down that asset and make a great return for our investors. So it was just a really great story, and I could elaborate on 5 flips that happened after that. That's how it got started. That's me in the cockpit of a 737 for Alaska Airlines and my daughter on her first flight out to Maui. And so I used to work for Alaska. I since resigned, and I work for Delta, very part-time. Love flying. I was an airline pilot at 21. Grew up fast, very checklist-driven approach to everything that I do. And of course, Scott being his military strategic self and very checklist-driven, it was sort of a match. I'm very kind of, let's see how we can get creative and make things work. Scott is very, let's get it done. Let's do the procedures and the process and stick to plans. So we really complement each other well. And we started Spartan. So this is our team today. Absolutely love our team. We do everything from acquisitions to syndication. We do the property management of all of our store locations. We do the asset management. Any development that takes place, we actually handle all the construction in-house. We also do all the feasibility and intelligence studies that go into the project. So I'll hit on that a little bit as we go along. But why storage? Everybody kind of thinks, I don't have a storage unit, I don't get it, or maybe I do have one and I totally get it. But as Marie Kondo says on her show, if it doesn't spark joy, put it in self-storage on autopay. So that's what really happens. We don't actually get rid of our stuff. We put it in self-storage. It goes on autopay. Maybe there's a first month move-in special, but then we don't move out. So it's turned into a $39 billion industry because of that. There's 1.7 billion total rentable square footage in the United States. Again, there's 55,000 plus, maybe 60,000 storage facilities. If you took every person in the United States, it would average about 5.4 square feet utilization per person. So if there's 100 people in the room, there's a 500 square foot utilization among the crowd. That's kind of another way, or 540 square feet. About 10% of households use a storage unit, and the average price is just under $90 a month. And the storage industry is under rapid consolidation. I don't know if you guys are paying attention to the storage industry right now, but it is rapidly getting bought up. There was actually a study, a little note that came out the other day that Blackstone, Cascade, and 2 other companies could buy every single property that sells this year and only be 0.2 of their platform. There is a ton of money in storage. Specifically, Blackstone bought Simply Self Storage for $1.2 billion back in Q4. Bill Gates invested a significant portion in StoreMart, one of the largest self-storage operators. And just 2 days ago, Public Storage bought its competitor for $1.8 billion, a big consolidation of properties in Maryland, DC, and Virginia, in New York City. So it's rapidly consolidating. There's been a bunch of other $500 to $600 million consolidations. And that's why we made the decision to free up, to launch the Free Up national brand. We wanted brand standards and consistency across our store locations to make our portfolio a little bit more consumable by a larger company at some point in the future. So why storage? We're flipping houses. We were doing condo conversions in our nation's capital. We were doing ground up. We were building new homes. Why storage? So Scott and I kind of pivoted and took a break and said, he always says, if you don't know what to do, take a knee, grab some water, right? And think about it. So we went into storage because it's recession resistant. We looked at the last 2 recessions, and self-storage was the top performing asset class during the last 2 recessions. And it's because people use it because of life events. I remember one of my last flights, COVID was just starting and the airports were empty. and I'm walking through the terminal and there's a passenger there, and I just couldn't help myself. Why are you traveling right now? And everybody, no one's traveling. And they said, well, my mother just died and I got to go down to Florida and I've got to grab all her stuff and put it in storage. And I was just thinking to myself, that's it. That's a life event. That's why people use storage. There's a consumerism part of it, but there's also a life event based event. So during the Great Recession, self-storage was the least foreclosed upon asset class. During COVID, we saw a lot of success during storage as well. So whatever you consider that a big recession or not, or maybe it's not over yet, storage performed very well and proved out its darling asset class status. So we saw this chart in 2016. You notice I only got the chart going in 2016, and we said, hey, storage is on an absolute tear. It's self-storage REITs are outperforming all other REITs and the S&P by over 300%. During the last two down cycles, storage rental rates actually increased. We also like the fact that it was easy to own, easy to evict, and easy to operate. So the 3 E's. But just to kind of, just jump back into what people use it for, because everybody's kind of like, me personally, I've only used storage one time in my life for 3 months during a life event. I was going from a small house to a bigger house, and because my family was growing, and we put our stuff in storage while we were transitioning between homes. But there's 30% business utilization at our properties. We have local businesses, contractors, retirees, downsizing, moving, landscape companies, distributors, college students. We have a couple of properties around universities, divorce, relocation, seasonal equipment. The list goes on and on and on. It's not just too much stuff. So why we liked it, the 3 E's, easy to evict, own, and operate. We have about 7,000 units and about 20 toilets in our portfolio. So if you can imagine, we're getting the rent per square foot in some markets that multifamily gets, but we don't have the maintenance and the CapEx uncertainty that you get with operating a single family home or a multifamily. And I invested multifamily and single family. I love it, but storage is one of those asset classes where you don't have to worry about that as much. No appliances, countertops, cabinets. When we turn over a tenant, we sweep out the unit, roll down the door, and put a yellow lock with a new code, and it's ready to rent. We also, when we look at kind of the different comparisons, we all love real estate because it's tax advantaged. When you look at self-storage versus multifamily, single family, and flips, and the asterisk is, for flips, because obviously unless you set up your personal asset protection or tax strategist strategy, taxes can be a little bit different with flips. If you do S corps or C corps or something like that. But the average stay generally across the board is pretty good. Single family homes, people can stay in your rentals for a really long time. Multifamily single, we have, and in self-storage, our average stay is about 48 months across the portfolio right now. So we have a very long stay. It's month-to-month leases, so it's good for raising rents when we want to raise rents, but typically our customer is going to stay about 48 months. Economies of scale, this is where it gets a little bit more difficult. You've got to have a really high-functioning team to have 7,000 single-family homes. And when you start getting down to automation, that's what we love. And all of our facilities are fully automated. You don't need to interact with anybody to rent a unit. So we still have people at our property because we believe in customer service, and there's a lot of maintenance and other things to do around the property, like sweep out units, change locks, clean up trash, things like that. But our facilities are fully automated. So if you go up to one of our properties, you type in a gate, you pull up to the gate, you can call in a 1-800 number or call center. You can book on your phone. You can upload your driver's license, pay with a credit card, get a gate code, and move yourself in without talking to anybody. So it's a very automated process. Rent recapture. So what does that mean? That means that if somebody doesn't pay, we can have them out within 30 to 60 days. So what's wild about self-storage is we have in our leases the ability to put a lien against all of their belongings if they don't pay and auction off their stuff. So if you can imagine a single family home or in multifamily, let's say somebody stops paying, imagine you're able to go into their apartment, take all their stuff and put it up online in 30 days to auction it off. Crazy. It's wild. So we have that collateral against their stuff. So if somebody doesn't pay, we have the ability to auction and recapture that rent that we lost, and we get a rentable unit back. So we really like that. And then the low maintenance. I always say, is it worth moving for $10 a month? So when you have a 750 unit storage facility and the rents goes up $10 a month, is it worth it? Are you going to get out on a Saturday, get a U-Haul truck for $50, maybe $100, and go move your stuff to a competitor who's maybe priced about the same? We just see about a 7% turnover. If we raise rates, we see about a 7% turnover on the average. We also like all the revenue that we can do at the property. So I had a little fun with this. We add in propane sales at some of our store locations. That's a great way to attract customers to your properties and make it a place of convenience. We also charge tenant insurance. So one thing that we get to do is we actually will charge our tenants, require insurance. They don't have to go through ours, but if we have a preferred vendor, it's a revenue share. So if they're paying $8 a month for tenant insurance, we may be splitting 40 or 50% of that. Merchandise sales, that kind of speaks for itself. If you need boxes, tape, or moving supplies, you're probably in the middle of a move, and we do a lot of merchandise sales. If you have excess land, boat, vehicle, and RV storage is a great way to use that excess land for ancillary revenue. Storage auctions is a great revenue source. We do all of our auctions online. It's not like the show Storage Wars. The rent that you recover can only go towards the rent that you lost or any expenses associated with the lost revenue. So anything that's left over after that goes back to the tenant. So the reality is we just want our unit back. And typically this isn't a huge revenue driver, but it's a nice tool to get your facility back from the tenant that wasn't paying. We do ice and vending sales. So we do sales of locks. We do bags of ice and things like that. PO boxes really help drive, you can do $200 a year for a PO box. And usually that's coupled with a FedEx UPS drop store and notary services. So you can go there, you can ship, you can grab your mail, you can get something notarized if you're in business. You can rent a U-Haul truck and move out. So I know they used to do U-Haul planes and anybody could go rent an airplane and fly it around, but I think they stopped doing that after a string of accidents there. So I think they stopped that back into, sorry, it's a bad joke. But no, we do U-Haul truck rentals at our properties. U-Hauls are kind of a loss leader, honestly. That's the spare land. You have the property there, you can rent them out. But what's great about them is it brings people to your property. So, hey, I'm going to go to the U-Haul rental and I'm going to move. Oh, they got a storage unit. I'm going to throw my stuff in, so it's more of that. But it's a lot of horsepower to run those U-Haul things. You have to clean the trucks. You have to hand the keys off. It's just revenue share. So we don't actually own the trucks or operate them, but it's labor intensive. And then cell phone towers. We have cell phone towers at some of our properties. Actually, I think 3 right now have cell phone towers. And then we put ourselves on the cell phone tower registry whenever we buy properties so that the cell phone companies are aware that we have a property that they could put a cell phone tower on. It doesn't work out all that frequently, but it's just another thing to think about. So what do we want at Spartan? So these are the 2 bread and butter deals. The deal on the top is what we're going to talk about tonight. It's the case study. That is I think it's 11 buildings with 2 vacant acres to expand. So we buy the in-place cash flow, and then we use that 2 additional acres and we build additional storage units. That is our straight down the fairway deal. That's what we do. I think 9 of our properties are pretty much that right now in our portfolio. The deal on the bottom is a ground up development deal. That's actually a facility that will open in 40 days. We took raw land and we completely scraped it, and we moved wetlands. We've got zoning, utilities, easements, and we built 755 units, or about 110,000 square feet from raw land. So we look at both. We do ground up and we do value add existing properties. So if you take away one thing tonight about storage, is that it is a 3-mile business and you have to do your demand study. And if you don't do your demand study, You don't know if you can execute your business plan. So the second largest line item at Spartan in our expenses is data. So we spend hundreds of thousands of dollars on data because somebody can send us an address or a location, and within about 30 seconds, we can say yes or no. So we have 3 people full-time committed to doing feasibility study. Lindsay Lewis, our director of business intelligence, it's Scott's wife. She's very smart, and she used to work for the CIA in Washington, D.C., hunting down terrorists. So she knows a little thing about finding stuff and getting data. So she's very good. Tristan, who I actually think is from Pasadena. He just joined our team about a year ago. He does an excellent job. He mystery shops competitors, calls for occupancy, does pricing checks, runs around, mystery shops our our competitor properties and things like that. And then we have Max, who's coming on as a full-time employee very soon. They look at everything from demand, population, saturation, storage facilities in the pipeline. Is anybody else going through the building permit process? Because if you don't consider that into your saturation calculations, you're going to have a problem, because all of a sudden you're going to have the market flood with another 1,000 units. So you really have to understand your 3-mile market, and you have to understand, I was talking to Vivian earlier in the breakout room. Let's say the state of Washington has an average utilization of 7 square feet per person, and you're looking at a market in Washington, and that market has a saturation of 11 within 3 miles. It's an oversaturated market. So that's how you got to, and if you don't have that data, it really doesn't matter how many houses are coming and what a realtor thinks about the area or whatever, or your gut feeling. You've got to look at those demand numbers and understand if you can move forward with that property or not. It might make, if you're just stabilized and you're not really worried about lease up, okay, that might work, but you really have to understand the demand study. So big takeaway there. So Lindsay and her team took the whole United States. There's only 55,000 storage facilities in the United States. We're buying 24 this year. So where do we look? How do we take a whole United States? And you might think, wow, that's a lot of markets to focus on. But when you don't have a lot of product to buy, you have to go wider. So you have to look at the markets that you really they have population growth, net migration, new jobs, employment, income. We look at rental rates, because we can't build new units if they can't support the rental rates that deliver. So for example, if construction costs are anywhere from $50 to $100 a square foot, we can't justify building that if rents are below $6 a square foot. So there's some things that we have to do to make sure. So we took the whole United States, we put this on our website, we share it with the world. These are the best markets for storage in our opinion. So obviously do your own due diligence, but this is where we like to look. So we love the Pacific Northwest. We have a huge presence in Texas. We have, I think, 10 facilities in Texas. And we're in the process of buying 9 more facilities throughout Atlanta, Georgia, and Tennessee. So once we buy these things, who runs them? So this is our property ops team, led by Jackie. She's our asset manager and director of operations. Valerie, Sharon, Danica, Danielle, and Rachel. So we do everything from hire the staff at the front lines to train them through our Free Up University. We have a training class that we put them through. We have regional managers, and we have daily check-ins with everybody. So we have people at the corporate level and at the property level and in the regions overseeing our properties and managing them directly. So if you're wondering, hey, what kind of revenue, what kind of, what would a P&L or a pro forma look like? These are some of the things that we have in revenue on the left. These are some of the things we have in expenses on the right that this property team takes care of. And I'm happy to share a copy of this presentation if you want to take that away. So this is who finds deals. When you have 154 markets, we have about 200 brokers that we have direct relationships with. We have a 6-person acquisitions team. So you can see Tristan's on that team as well. So he kind of focuses on both feasibility, underwriting, and helps serve the acquisitions team. So we look at about 3 to 4 deals a day and try to say no as fast as we can. So Christina met Scott, he's a guy that doesn't like to say yes. He just we look for reasons to kill it as fast as we can. We throw it in the trash and move on. So we try to increase that funnel so that we can look as many properties as we can, because the market is very, very hot right now for storage, and there's a lot of money in it. So that a lot of overpricing right now. Last year we put out 9 LOIs, or 19, this is actually 2018, I should update this. 19 LOIs in 2018 and 3 closed projects. Last year we closed on 9 new assets, and I believe we had 24 LOIs and about the same amount of deals reviewed. So we get quite a bit of deal flow, and we say no a lot. So tonight I'm going to talk about a case study. I'm going to show a video of the property that we're going to talk about. And this property was brought to us by a broker back 2 years ago. It's Mini West Storage, just south of Dallas, Texas, in a town called Corsicana. Came with 735 units, about 81,000 square feet of existing. Had indoor units, so climate controlled, air conditioned, and outdoor. Had a car wash, which we actually just sold. Had 4 bays and an automatic bay. We spun that off and sold it because that's not our primary focus. Had U-Haul rental trucks on site. The whole project was about 9 acres. It had the 2 acres of expansion, and we're going to talk about how we developed it and added those 2 buildings to it. This is a time lapse of the construction, kind of fun. We put up a construction camera and just captured the units going up. It's kind of fun, kind of obsessively looking at the cameras all the time and seeing what was going on. We have a bunch of projects going up right now, and those time lapse cameras are really cool. This is the inside the new units. We were just there last week. We had a ribbon cutting ceremony. Brought the whole city in and made a big event out of opening up the 2 additional buildings. Needless to say, the city planners were really excited to see some new business in the area. So diving into it, again, we bought it 2 years ago, $6 million. And when we bought it, it had $443,000 of in-place net operating income. So we verified that income, and that's what it had when we bought it. It emitted an effective 7.38% cap rate, which, if you're familiar with storage today, good luck finding an asset like this with that high of a cap rate. It doesn't exist. They're all down into the 5s now. The bottom, we talked about U-Hauls, vacant land, and it came with the car wash. Our plan was to spin the car wash off and sell it. We just did that. We just sold the car wash for $1 million at the end of February. Which was a great play for us. So I'm going to dive really deep into how to put a deal like this together. So this is our sources and uses. So if on the left-hand side, we got a local bank loan for $5.2 million, and we raised $2.3 million of private equity from our investors. So our total capital stack was $7.5 million. $6 million, I'm using pretty big buckets of money here. $6 million went to the purchase price. $1 million was set aside for construction. We took $250,000 of project fees. That's acquisition fee, asset management, property fees, for managing the property, things like that over time. And then we put $250,000 in reserve for a rainy day. So that's the financials. We did it. We took 4 weeks to do a feasibility study. We mystery shopped all of our competitors. We looked at the rental rates, the job growth, the population growth, all those things. And when that was done, we did 60 days of due diligence. And we put up $60,000 of earnest money that only went hard when we signed off on the end of our due diligence period. So our due diligence period included things like going to a civil engineer, getting a survey, an environmental study, a geotechnical study. And I'm happy to share, we actually have a 680 point due diligence checklist that we take every property through, and I'm happy to share that with your group. I'm happy to pass it along and forward that, and that goes through all the things that we check before we move forward in due diligence. It's quite a process. The next thing we did is we looked at the physical occupancy of the property. So how much of the occupancy physically was occupied, and then we looked at economic occupancy. And the difference there doesn't imply that people aren't paying. The difference there could imply partially that, but it's also that rental rates for the property. So let's say you have 100 people and 100 units, that's 100% occupied, right? But if 100 people are supposed to be paying $100 a month and they're only paying $80 a month, you have an 80% economic occupancy. So when you looked at the rates were severely under market and they weren't charging the customers what they should be paying, which is usually a great sign of a good opportunity. We mystery shopped our competitors. We went to every single competitor in the market. We walked in, we checked occupancy, we checked rental rates, we checked data. We made the story of why we thought we could build and expand those additional units and move the rental rates up to what we thought would drive a good pro forma for the property. So if you're unfamiliar with what a rent roll is, and when you're looking at multifamily, a rent roll is essentially just a big snapshot of what everybody's paying right now. So when you look at a new facility, you want to get the rent roll and you want to look at all the different unit types and what everybody's paying. And I'm not going to go through all these types, but I just wanted to show you this big snapshot because you can see there's a 5x10, a 5x10 climate controlled, and then you have a 10x10, and you have all the rental rates and what people are paying. And when we summarized all of these rates, we noticed that there was a massive gap between the rates that they were charging when you walked into the store and what people were actually paying, which represented a massive opportunity. So we found that there was $165,000 a year gap between what they were paying and what the street rates were. So the street rates are what is marketed. So if you're doing the math here, six cap divided by $165,000, that's the value that's representing that you're finding here. So we're going to focus on just one rent roll to do like a real live exercise here. So that rent roll right there to the right is a 5x10 unit. And if you notice, the top price there is $23.50. So one customer is paying $23.50. Now let's go down to the bottom. See the $47, and there's 67 people in that unit type paying $47. So everybody below that is not paying the street rate. We also went out into the market and found out that most competitors were charging $55 a month. So not only were the street rates incorrect for the property, and our facility was nicer because we had got hands on all the properties, but there was a gap between those rents. So, the example, there's 19 5x10 units here paying less than $35 a month. So we went through every single unit type, 5x10, 10x10, 10x15, 10x20, and came up with that $165,000 number. Now, you don't just snap your fingers and raise rents, right? You don't take over and become a really unpopular under new management. So what we do is we conservatively underwrite raising the rents over time. And we basically cut that number in half and said, for our pro forma, we're going to raise rents $72,000 over 18 months. So if you're doing the math here, what does that add in value? So that's about $6,000 a month in additional cash flow. And it adds about $1 million to the valuation of the property. So NOI divided by cap rate. So the next thing we did under DD is we looked at those 2 acres, and you think, the broker said, yeah, you can build on those 2 acres. Hold on, not so fast. You actually can't build on those 2 acres. You could only build on half of those 2 acres, because if you notice, if you check on the title, there's an easement. There's a dotted line here that stripes right down the middle, and that's a utility easement for gas. And you cannot put any buildings or physical structures over that easement. So it's very important when you're doing your due diligence, get your civil engineer on board, get your title attorney on board, and start going through the easements to make sure that you can do what you think you can do on the property. So the civil engineer lays out the site plan, and he says, okay, you can put about 36,000 square feet in this area. That's what we think. The feasibility study said we could build 40. So there was 40,000 square feet of demand. We're like, this is, we're an unfamiliar market. Let's just underwrite it at 20,000. So we broke it up into 2 buildings and said, we're just going to underwrite 20,000 square feet. And everybody asked, what's the cost per square foot for storage? What does it cost to build new storage? And here you might say, okay, I'm doing the math. It's $50 a foot. So be careful. In Seattle, Washington, not because labor is more expensive here, we're paying about 110. And the reason why is not because it's Seattle, but because that's partially part of it. But the dirt, So what you have to do with the dirt really drives your price per square foot numbers. So in Seattle, we had to take 1,000 truckloads of dirt and haul off the site. We had to remove 18,000 yards of dirt to get the site to finished floor elevation. That's $25 a yard. So $500,000 almost in cost just to scrape the site. So this site was pretty flat and graded, and the topo said as much. So once you get the foundations, the price doesn't vary all that much. You got the steel guys. We use Forge Construction out of Boise, Idaho. They come down, they set up shop for a couple of weeks, they throw our buildings up. The foundation, concrete hasn't changed in pricing all that much. Steel's gone up, but we built this for about $50 a foot. We actually came in at $43 a foot, which is great. Took us about 6 months to build it. And we gave ourselves 15 months once it was built in the pro forma to actually lease it up, because all those customers don't just come the day you open. You hope they do, but that's not how it works. So with the cash flow that additional building created, it adds about $2.34 million to the property through the increased cash flow. The other things that we did to the property is we make it great. So we increase rents to market rate. We train the staff to enhance the customer service experience. We do community partnerships, business relationships. We do tenant insurance, retail sales. Overall, with just rental increases, we increased the revenue of the property by 38% in about 18 months. And you're probably wondering, how does Costc work? How is it compared to multifamily? Is it the same? Is it different? How do you depreciate? So when we bought this property, we depreciated $1.7 million in the first year, and then that flowed up down to the partnership. And this is a real K1. So this is the first year we bought the property. You can see the K1 here. This is I think an investment of $50,000 from a limited member, and they got around $21,000 loss in the first year due to depreciation. The fun part about this is they have a distribution. I think I can't see because of the screen. Yeah, $1,600. So basically, when you buy these multifamily assets or storage or RV parks, mobile home parks are the best. They come with depreciation through a cost segregation study. And usually it has enough depreciation in the first year to shield any passive income for that asset for 5 years. So, it depends. Check with your CPA. I'm not your CPA or your financial advisor, but, typically these things come with depreciation. Let's see. There we go. So assumptions. Sorry, I'm having fun with the memes here. 40% EGI. So what is that? 40% means for every dollar that you create in revenue, we're going to spend about 40 cents to get that revenue. So it's payroll, property taxes, insurance, utilities, things like that. So your biggest variability in underwriting is going to be property taxes and insurance. So insurance is up across the country. I don't want to get into a conversation about global warming, but global warming is a thing. And the reality is that insurance companies are catching on to it and they're raising your cost. Our costs go up every year in property insurance. So that's your biggest variable. Can't control that really. And the other thing is property taxes. You got to make sure that you understand property taxes and you've adequately accounted for that when you take it over. So we're operating our portfolio at about a 35% EGI. So we always overestimate a little bit in underwriting. We ever only assume that the property is going to be max 90% economically occupied. That's where we peak performance our pro forma. We never say 100% because it's not reality. We assume 20,000 square feet of expansion. We assume we'll exit in 5 years at a 6.6 cap rate. So those are kind of our assumptions in underwriting. So if you're wondering how to build an underwriting file, those are some things that we put in. Again, it may be different for your situation, but that's what we do. So financing, this is a fun part. We've got 75% leverage. That was about 4.5% interest rate. We called like 80 lenders. We're a little bit more dialed in now in Texas with our lending partners. But we just went with the bank next door, conventional lending, good old relationships. We went with the Community National Bank of Texas. They've been fantastic. They gave us a 2-year IO period, which ended this month, and 25-year amortization. Thanks for that reminder. And a $1.6 million draw for the expansion. So this is a pretty cool loan. So let's just rewind here. So $6 million purchase. So they gave us $4.2 million at closing to buy the property. And then they gave us $1 million draw for construction. to pull on over 3 years whenever we started construction. So it's kind of like a mini perm loan, which was pretty neat. It was pretty creative. You notice I said $1 million, and that's 1.6. So we ended up going back to the bank and saying, we could actually put 40,000 in here for 600,000 more. Would you work with us? And they said, absolutely. Here's another 600 for the draw. So we increased our proceeds a little bit. So this is fun. So looking back 2 years ago, we proposed to raise rent $72,000 per year. We actually got 133 over an 18-month time period. We said, with a 20,000 square foot expansion, that would increase NOI by 155,000 a year. We're putting in 40,000, so we doubled the size. So that's about a $300,000 per year expansion. And the existing NOI obviously is the same. And so the way that we come up with the valuation in our underwriting is we said we would get the property to a 670,000 NOI at 5-year mark. And that values the property at 10.151 million on a 6.6 cap rate. So right now our trajectory is a little higher than that. We're at 876 NOI, or about a $13 million valuation at 6.6 cap rate. This is kind of fun. This is our performance on the property. So we actually, we're firm believers in data and monitoring the business plan for trends. And this is basically what we report on every quarter. So we look at revenue proposed versus actual, expense proposed versus actual, and NOI proposed versus actual. So this is the historicals of the property. So you can see that, revenue, I think this quarter it's going to be a bit higher just because of the expansion. We started leasing up the additional units. Expenses have been significantly lower than anticipated. Again, we kind of go for that 40% EGI. It usually comes in about 35%, but I don't recommend you underwrite that way. And net ordinary income has been very good. This is our website. I know Christina kind of showed that before. This is it's myself, Ted, and Lauren are on the IR team, and I left a lot of time for questions. So hopefully that was pretty good.
I was muted. Yes, that was great. And that was perfect. And that's the depth of the case study I was hoping for, because this is an asset class that a lot of us don't participate in. Like I'm not going to be a direct owner on a storage unit. I have no interest in that, but I'd be an investor on a storage unit, but I would never be able to have access to this depth of explanation if you hadn't walked me through it. A lot of us are familiar with the concept of the cap rate and multiplying value by adding gross rents, whether it's a multi-unit, whether it's a storage unit, whether it's an industrial property. That's always one of your biggest leverages, but I was glad you went into all that detail. Okay, so I encourage you to type your questions into the chat. Alex already gave us a question. Thank you, Alex. What's the reasoning for not going vertical on the expansion?
Yeah, great question. Love that question. It's the reason why is because every market's different. If you go vertical, we didn't have the demand for it. There's just, we're going to fill those buildings adequately, we believe, from our studies, and we're going to be pretty good. None of that market has 2 stories, or the market doesn't have but single story. It's interesting. So the reason why people love our facility at Mini West is because we have wide drive aisles and drive up units. So, if you're in downtown Seattle, the expectations you're going to be in a 4 or 5 story storage facility, and you're going to have an elevator, and you're going to have to go up the elevator and down the hall, and nobody wants to do that. They do that because they have to, but nobody wants the 4th floor overlooking whatever in a storage facility, right? So as you go up, you lose price per square foot. So it's really important to understand your market. And in this market, it just doesn't, you wouldn't get much bang for the buck going 2-story. Now, is it more expensive to go 2-story? It might not be. And I love giving this little tangent about construction because foundations are very expensive, and they're not that much more expensive to go 2-story. And if you stay 3 stories or below, you don't have to comply with a 4-story fire code. And it's actually pretty efficient because the different levels are just pan decking, and the structural steel doesn't get that much more intense. And you only have one roof 4 walls, 1 foundation versus multiple buildings with multiple foundations, multiple roofs, etc. So you can get a lot of efficiency out of a 2 or a 3-story building, but the market may not like it. So great question.
All right. Next question. Assuming an area meets your criteria, are you coming in all cash to acquire, or do you ever do creative structuring beyond the structuring you've already described?
And you've got all the good questions, Alex. Thanks.
Yeah, he does. He has all the good questions. I'm just going to run with him because, come on, guys, there's got to be other
I
people.
love that question. Again, because yes, you know, we buy sub-storages all cash. We'll raise 100% equity and take down a project because it just doesn't make sense to put loans on it. You know, it might be so small that, you know, the banks aren't going to want to mess with it. You just want to close. But actually, our acquisition strategy is very unique. We're actually acquiring these properties with private debt from investors. So when we go take down a property, we raise a private note in the first position with a personal guarantee, 70% LTC or lower. We pay a point, usually 7% per annum, and we just take it down because we don't want to be in a rush to find the perfect bank and the perfect loan. We want to be competitive on the purchase, and those loans are usually 6 months, and we just go to a local lender and refinance out the property and just roll those investors into, you know, if they want to, into another first position on the next acquisition. So it's very creative, to answer your question. And it's a mix of private debt investing and equity investing. And sometimes it's just equity. You know, if I could go on a tangent for a minute, we actually have a 4 property portfolio in Tyler and Longview, Texas right now. And what's interesting is, you know, portfolios are really interesting because they give you the flexibility of acquiring economies of scale in a market. So we're actually acquiring a 5th property with that portfolio, and the cash flow is supportive enough where we've actually paid 100% debt to acquire that next property, and still kept our, you know, DSCR above a 2 and our LTC below 70%. So, you know, there's a lot of creative things you can do in real estate in general, but, you know, we do some really creative financing stuff. So good question.
All right. Do you see Alex's next question?
Yeah. Do you enter an area plan to open multiple? Yeah. So we do. Yeah. So we've got a acquisition strategy that when we go into a market, it's funny. We do an all hands meeting with our team, and we go on. We tell our store managers, like, hey, if you know somebody at your church, somebody in your community that owns a storage, and you know they want to sell, we want to buy. So we do try to do scale in markets, and that was my 4 portfolio example where we actually are buying a 5th property in that portfolio, which is great because there's not any dilution of equity for our investors in that. It's just another scoop up, and we don't have to. We already have a regional manager out there who's just going to, you know, handle that property, so it's very efficient.
Hey, full disclosure, I'm actually looking at acquiring one right now. So.
Oh, cool. Where at?
Denver.
Be careful.
Talk about Denver. No, I want Alex. I do want you to share, but I also want to hear what Ryan has to say about Denver. Go ahead.
I
don't want to. Yeah. So we own a property in Denver. It's doing fine. But just do a demand study. Denver is a bloodbath. There's 1 million square feet oversaturation on some street corners. Denver's overbuilt. Now, good story here. So when somebody asks you, how is Denver? To say that it's bad is kind of an unfair statement. Or if someone's like, hey, how's the storage in Seattle or Houston or Austin? You can't really generalize. You got to look at that local 3-minute, 5-minute, 7-minute drive time to really understand what the demand is. But there's a lot of soft spots in Denver right now because of overbuilding. So just, you know, when I hear Denver, I'm like, because we live there. I don't live there, but you know, we have our office there, and we look at a lot of things that trade in that market.
It's a more unique opportunity because it's not it's in downtown, and they're basically micro storage type units.
Sure.
Kind of catering specifically to the downtown market. There's no drive up. So it's, like I said, it's a little bit different.
So I would call Bob Copper or Jay Graham, and I'd have them do a feasibility study for you. before you move forward. It would save you a lot of, the bank's probably going to require it. If you're buying it all cash, great. But
No, we're doing creative on it. So
Yeah.
it's a little bit different. It's less than $1 million in terms of what we're doing.
Sure.
So
Yeah, do a feasibility study. You'll definitely want to understand, your business plan execution, and Bob Copper does a great job of that. So he's I don't work for him, or, I know him from industry events, and he does a great job. So.
And we can certainly talk offline. I've got a few other things I'm working on that might be interesting.
Yeah, absolutely. Yeah, no problem.
All right. Any other questions for Ryan, guys? I did have a question, but I think it's mostly been answered, which is, what I would think. I'm a city girl, and so I'm used to multiple level storage, and I'm used to not wanting to pay for air conditioning. So talk to me about when you're creating these single story units that all have exterior access. I'm like, where's the air conditioning? And then you have to pay for air conditioning. And I avoid paying for air conditioning. I have my grandmother's furniture in non-air conditioned units, which of course the antique dealer would be like, what are you doing? Right? So talk to me about air conditioning, its true viable or viability on actually bringing return, especially when you're looking at these all floor level units.
So in the Pacific Northwest, it's not going to move the needle, because it's a very mild climate. And actually, we're building indoor units in just south of Seattle right now. That the one that I mentioned was going to just open, and it's just heated. So we just have a gas fire resonator heater that hangs in the ceiling. We have some circulation with the HVAC, and in the summertime, we just circulate the air. But it's not worth putting an air conditioning compressor on there, and people aren't going to pay extra for it out here. In Texas, high demand. It's hot, it's humid, and the humidity is really what you're fighting. And you think about it, like in Texas, the saturation level in Texas is very high because we're seeing 15 to 20 square foot utilization in Texas, because you put something in your Texas attic, it's going to get moldy, and you don't have a basement, so there's nowhere to put your stuff.
Yeah, you don't want a basement in Texas. It's too much oil. It's going to rot everything away.
Exactly. So that's why, I said earlier, the average is 5.4 square feet per person. So when you see some of our deals come out and they have saturation numbers in the 20s, you're like, what? Like, wait a minute, isn't this way oversaturated? But it just depends on where it is. And that's why getting a demand study and getting those comparisons is really important, because and so getting back to your climate control question, it really depends market by market. Florida, Texas, southern states, yes. Pacific Northwest, not so much. Some markets, it's pretty even. Like we actually closed on a property in Bentonville, Arkansas, and we're not seeing a big demand for the climate control. Some people just want to drive up, open the door, put their stuff in, and throw the door down and leave. They don't want to go through a hallway, go up an elevator, et cetera, because it's a pain. So it really just depends on the market that you're in. And that's where a feasibility study provider will help you with your unit mix. So it's very important.
Okay. Kirk, you got a question?
No, I don't. A lot of interesting stuff. Where was the property that you did the example of? Where was that one located?
Corsicana, Texas. About an hour south of Dallas.
Corsicana, Texas.
Yeah, you guys ever go to? You guys ever get fruitcakes from the Collins Street Bakery? You guys ever had a fruitcake in your life? Okay, good, because they're not.
I have had fruitcake.
You what?
I have had fruitcake. Yes.
Poor thing.
Yeah, it's kind of gross. Scott loves them, by the way. So next time you see him, give him crap about liking fruitcakes.
Oh, yeah.
He's one of the few very people that actually like it.
Yeah,
Exactly. A lot of people make it, so there you go.
Well, the Collins Street Bakery is the fruit maker or fruitcake maker, and they're in Corsicana. So that's their claim to fame. Hey, did you guys ever see that Netflix documentary Cheer? I think is what it's called. Anyway, My wife loved it, and it took place in Corsicana. And then the only other thing is everybody's had Russell Stover candy, right?
Oh yeah.
Yeah. They manufacture. It's the plant or the factory or there is in Corsicana. So that's there you go. That's Corsicana for you.
So it probably smells good.
It does, yeah. And then there's Corsicana Mattress, which I don't think anybody really knows, but it's a very big distributor of mattresses, and so good population growth. What makes the southern states and Pacific Northwest more ideal than California, for example? It's just obvious, lower price points. We just do a lot of development, and I know we're just not familiar with California development. We haven't done any deals in California yet, so I don't know. I don't know the answer to that question.
Yeah, I know. I noticed that too, that it's not on your map of your MSAs that you guys study, is that there's LA wasn't anywhere close.
Yeah, I don't, we're looking, I know we're looking now, but that map might be a little bit outdated, but we just haven't found anything that we liked yet, so.
Well,
Yeah.
as Kirk and I can warn you, development in LA and in the 5 Southern California counties are a pain and
Yeah.
not something I would suggest in general. So maybe just stay outside of the 5 counties. You might want to do that. Just a suggestion.
Yeah, we usually, our thesis is we stay away from the urban core in general, because we're a big tertiary market. It's good for population growth right now, and competition is a lot less. So we really thrive in the tertiary markets. Should I answer the next one?
Yeah, go for it. Yep. Is there a reason why the capital raise is done on acquisition versus value add expansion and construction?
Okay, yeah. Is there
And there's another one after that by Hannah.
Yeah, so is there a reason why capital raise is done on acquisition versus value? So it's interesting. So we raise funds to buy the property. That's how we arrange the financing. So that's why it's done on acquisition. Yeah, and then usually a bank loan will give us the draw for the construction, or we'll go raise private debt from our investors. I don't know if that really gives you a great answer, but.
Well, I think Alex, to kind of speak into it, is it because their model is about purchasing, and that's really what they're looking for, is to purchase something that's underperforming and then add value to it. They probably want to sew it all up from the beginning versus they actually have something and now they're going to shift it. They've bought it with the plan in place for how to value add to it. Otherwise, they wouldn't have acquired it to begin with. So,
Well, like I give you a good example, because I had my dad's in the syndication for self-storage with actually the local operator here in Southern California, and the developer acquired the property first, and basically the capital raise from investors is part of their stack, because they do get bank financing. And so I don't remember much about the structuring, but I think it has to also do with just investors kind of having a little bit more of a security in knowing that the.
Yes. Okay. I understand your statement now. So your question. So yes, sometimes we do that. So like, for example, that Seattle project, it took us 4 years to entitle that. We had to move wetlands, CUP, the whole 9 yards. We didn't get our investors in until we had site plan approval. So yeah, so we waited, because it's nothing's worse than dragging your investors through the mud on an entitlement process. So it's not fun. You want to kind of close, and it's like, yeah, we're going to go vertical the day we close. That's an enjoyable process for the operator and the investor. So we try to avoid raising capital before we entitle and do the thing. So we do that. Yep.
So if you wait to bring investors in at that point, how do you fund those sorts of deals on the front end?
We just pay out. I mean, Spartan has a healthy operating reserve, and we just front the expense. So like we'll be, hundreds of thousands of dollars into an entitlement process before, actually Black Diamond, I think, was close to $1 million before we, bring in our investors. So yeah, and that's just our loss, if we can't get it entitled. So, I mean, not every deal can work that way. Sometimes the investors are introduced to entitlement risk, but we disclose that, up front. So everybody knows, their eyes wide open going in, knowing what the risks are, hopefully. So in the PPM. So, but yeah.
Well, and I think if I remember correctly, you guys also can take a deal down, like you said, by using private equity 100%, and then you pay them this increased rate, and then you will refinance out those initial investors.
Correct.
So, you can also manage your investor money that way by setting up the anticipation of, this one's going to take a while. We're going to you're going to give us this loan for a long period of time, which is different from your equity investors.
That's correct. Yeah, that's a really good summation. Yeah.
Okay.
Yeah.
I like Alex's next question. I want to hear the answer. Is there an exit strategy for the company? Is this for the company as a whole, Alex?
Oh.
You're on mute, Alex.
Alex needs to ask all the questions.
I was going to say, I'm not the only one that asked the question. So Hannah had a question about the holding period. So I think you should answer that first before you answer my question.
Okay, we'll answer Hannah's question first. So Hannah's question was about the holding period. I did see it go by. Let's see. What
Yeah.
does a typical holding period and return look like for self-storage?
Yeah, so for us, it's 5 years, but that could be longer if it's development, depending on how long it's going to take to develop and stabilize. But usually 5 years. For returns, I'll just say this. I'll just say that if it's you can look at a traditional expectation for core plus, opportunistic, and I'll say that we mirror the expectations for a risk-adjusted return. Without advertising returns. I don't really want to. I don't want to be salesy. So.
Thank you. I appreciate it.
You're welcome.
Go ahead.
Exit strategy for the company. Man, I love this question. I love the other question too, but no, there's not an exit strategy. There's an exit strategy for all of our deals. But we've been valued. We do offer all of our employees the ability to buy part of the company, not because we need the money necessarily, but we want to have a sense of ownership. We have very strong culture and values in our organization, and so we did roll out a MIPA program where people can, kind of like an ESOP where people can buy in. We did our first round last quarter, and we had eligible employees buying in, which is really cool. So let me talk about the storage assets for a minute, because I think that's a really important thing to consider. We want to build we want to have a $250 million portfolio in storage by the end of this year. At 500 million, you start really attracting some big money, REITs and publicly traded companies. So, and not only do you start attracting that kind of money, but you usually attract a compressed cap rate on the whole portfolio. So, you sell the diamonds in there, but you also bring up the value on some of the ones that they may not be that interested in. So that's kind of where we're going with free up storage. We want to build a big portfolio. We want to have an attractive exit for all of our properties. They're all individual deals. It's not a fund, but the strength of the portfolio brings up the value of all of our assets as a collective portfolio. And there's no denying that. I mean, there's portfolios trading sub 5 caps because there's so much money that wants to go into the industry. They're just trying to place the capital into high quality assets in a big portfolio grab, versus they don't want your $13 million property in Corsicana, but they want your Pacific Northwest portfolio, maybe some other prized assets within your storage portfolio. And yeah, in Corsicana, maybe kind of in that, right? Or a couple smaller ones, but they get the scale of just being able to place all the capital in that space. So that is one strategy that we have for exit, but we've underwritten each one of these deals to exit as is to like a regional or a mom and pop buyer. We're also considering standing up a fund in the future that would roll these stabilized properties into more of a core plus fund. So a lot of different ways to do it, but that's kind of our thoughts.
Okay, cool.
Yeah.
I love it. All right, I'm not seeing any more questions. I liked the question, so I was curious what your exit strategy was. Kirk, do you have any more questions?
I don't. It's been very informative.
It's been very informative. Yeah, you covered a lot of it through the presentation, so that's really good. I'm going to go ahead and end the meeting now, guys. So, if anybody, so thank you, Ryan.
Yeah, you're welcome.
Appreciate it immensely. Thank you for the time. Hopefully you can hang. What I'm about to describe, Ryan, that you may not know is we often hang at the end of the meeting and just sort of open up we don't do breakout rooms. We just let people talk, bring on their cameras and audios. And yeah, Cindy says, great presentation, Ryan. Thank you.
You're welcome.
And just chat about, well, what's current in real estate? Because I personally feel that the blood on the street, the news on the ground is really the most important about what's happening. Our newspapers are anywhere from, well, data inherently is 3 months behind because it takes a trend line in order to start saying there's something happening in the data. And then it takes the newspapers another potentially up to 6 months before that data gets presented into mainstream newspapers. So the best way to get information is by other people who are actively doing stuff in real estate right now. So, so yeah.